The technology for digital currency is already here. It's not something in the far or distant future. Private cryptocurrencies such as Bitcoin have been operating for over a decade. Financial innovation is relentlessly marching forward. However, central banks don't want to lose control of one of their most important tools in their tool chest, and have such taken a keen interest in the technology of digital currencies. This week I hosted an event with three of Canada's leading academics and how they would implement a central bank digital currency. Let me reflect on some of the challenges and risks of this innovation. Hi, I'm Bruce, and today I'd like to talk to you about central bank issued digital currencies. In 2018, the Marshall Islands legislated a new digital currency called the Sovereign, and it's now legal tender in that Micronesian island. Singapore's central bank created a digital currency backed by the Singapore dollar that runs on the Ethereum blockchain. Earlier this week, Japan's central bank kicked off experiments on a digital currency. They are the latest of central banks that have moved from research to putting something into the field for trials, which include countries like China, Brazil, Sweden, Thailand, and the Ukraine. I got a chance last week to talk to the lead researchers of the three winning research teams. Held at Rotman's School of Management at the University of Toronto, I heard perspectives from Professor Catherine Tin from McGill University, Professor Alfred Leah from the University of Calgary, and Professor Andreas Park from the University of Toronto. The full discussion can be found in the link here, but for the rest of the video I want to briefly highlight the 4 risks that I personally am watching out for as we move to a central bank issued digital currency. Firstly, let's spend a minute to talk about what central banks are for. Central banks have been around for a very long time. The Riksbank in Sweden is the world's oldest central bank, and it celebrated its 350th birthday a few years ago. Globally, there are over 170 central banks in the world. At a high level, they perform 3 functions. They control the nation's money supply, they act as the banker to the government, and they are also the lender of last resort for the private banks and the systemically important financial institutions if they get themselves in trouble. Some central banks also have an additional function as regulators for their domestic financial system. These functions are tools that assist them in their purpose. In contrast to commercial banks, which are seeking to maximize profits for shareholders, central bank institutions' purpose is to maximize the performance of the whole economy. As such, they play a pivotal role in nation building. It's noteworthy that the objective function of what maximizing performance actually is different depending on which nation, and generally will cover the different weightings about actual growth, employment levels, and economic stability. Now let's talk about the 4 risks that I'm paying attention to. The first one is that tension between privacy and compliance with anti-money laundering, counter-terrorist funding, and other regulations. The Bank of Canada puts privacy as one of their key priorities. And one of the critical design decisions that has to be made is whether the digital currency is going to be token-based or account-based. Token-based will be treated similar to cash. Privacy is going to be a lot less of an issue because there will be no data collection. It's harder to ensure though for your compliance for anti-money laundering. On the flip side, if you have an account-based situation, there will be data collection on individual purchases that could have adverse privacy effects. But the digital tracking will make it easier for compliance to understand where the money is coming and going. This particular conundrum happened to be the focus of Professor Tin's work from McGill. Now, we want to be able to maintain that maximum privacy for the money spent, but having limited privacy for the money received so that we can maintain compliance. Here, Professor Tin and her team proposed a novel solution, a privacy hybrid central bank digital currency. So when Alice goes to Bob to get her coffee in the morning, she normally would hand over cash. It's an anonymous transaction. In the digital version, what is proposed by Professor Tin and her team is that Alice accesses her ID-linked account of digital currency and then transfers a certain amount into anonymized private coins. These private coins will be untraceable, and then that is what gets transferred over to Bob's account, where Bob's account picks up the private coins and still protects Alice's privacy on what she is spending. The main goal of this architecture is such that you're not able to identify the sender of the money, but authorities are always able to identify the receiver of digital cash. Governments around the world are tackling this problem in different ways, and a lot depends on society's view on privacy. Number 2, smart contracts and digital money. This is often seen as the golden goose, the reason why we should be moving to a digital currency. To put in those added features to bills and coins so you can put programmable logic in there has the potential to have a massive economic windfall. Smart contracts have the capability of increasing the efficiency of settlements, reducing operational risk, and creating innovative products and services that we have yet to even imagine. But are we ready for smart contracts? How does one value a contract that now is conditional? Is it treated as an asset? Can we depreciate it? How do we overcome some of the complications of tax compliance? And then there are the ethical considerations. Could a government decide to make their social security payments such that you couldn't buy tobacco or alcohol products? What about fiscal policies, where you can make stimulus payments with conditions so that it can only be spent in small businesses owned by people of colour? The range of possibilities is mind-boggling in what you can do. And we need a system in which society can determine what we are allowed to do. I foresee, for example, a major change in the way the fundraising industry works, whereby significant bequests could have perpetual conditions tied to the funds. How does your industry segment get disrupted by this change? The third thing I'm looking at is the potential disruption between the relationship between commercial banks and central banks. Citizens put their deposits in the commercial banks. But with a digital currency, does that mean every citizen will have an account with the central bank? Is the central bank geared up for this? Does that mean they have to have a call centre so they're able to handle all the inquiries from the citizenry? And what happens to commercial banks when all of a sudden their retail deposit base disappears and moves into the more secure central bank? The pipe work on how central banks and commercial banks and citizens all interact together was the focus of the work by Professor Park and the University of Toronto. There's lots of interesting dynamics and a lot of unknowns in the way that the banking will look like in the future. And the final risk issue, which was covered in part by Professor Lear and Professor Park, was what happens when everything goes offline. Sweden, which has one of the most cashless societies in the world, had their governor come out a few years ago to say that, hey, we might have gone too far too fast. Are we leaving part of society behind who don't have access to the digital technology? And then of course, what happens when some of that digital technology becomes disrupted? So they are the 4 risks that I'm personally paying attention to as we inevitably move towards using a central bank digital currency. Since I had access to 3 such eminent experts, I asked them a bonus question at the end of our session. What do you think the future will look like? And here are their responses.
Yeah, I guess in the spirit of my proposal, I think there is increasing attention to the data privacy issues and more nuanced questions about what do we want to actually protect. And this is obviously like enhanced with better abilities of data analysis and the possibility to then build better things based on this data, which is relevant for many fintech developments. So this is 2 things, like more attention and thinking about that. And second, new financial products, like, individuals being able to participate as they are now in a greater set of financial assets and investments and better contracted. So I see things going nicely in an innovative way. Yeah.
I think that every country will issue their central bank digital currency. We will move to a world where more of the trading goes to these smart contract platforms. We'll have an app store where we can buy certain financial products that we can combine with money and use them from our phone. This will broaden the access for small corporations, access to finance. Financial markets will hopefully get more competitive and consumers can benefit from that. I'm an optimist.
I agree with Alfred that many countries will be issuing a CBDC within the next 10 years. Smaller countries will adopt, the CBDC of larger countries, so they will actually no longer have monetary policy. The financial sector as a whole, in particular retail banks, commercial banks, will shrink dramatically as many of the services that they provide are commoditizable and will move into an automated setting. Maybe they find other things to do. We will see a thriving ecosystem of interactions between existing blockchains, of different private initiatives. All of them will be, put together with programmable money. And the financial industry in 10 years, not so much the investment banking industry or the capital markets, but the industry as banks as we know it will have changed fundamentally, will look nothing like it is today.
So are you and your organization ready for a digital currency future?